Welcome back to the Deep Dive. Today, we're tackling a segment of the financial world that is just colossal. I mean, we're talking about a market estimated to be 4 times the size of the global equity market. And yet, it often gets overlooked or, dismissed as too boring. We're talking about the world of fixed income. We're talking about bonds. When people think of dramatic returns, they think of tech stocks or maybe commodities. But the bond market is really the engine room of global finance. It provides the stability and the capital for governments, for corporations, for everything in between. We hear terms like treasuries and junk bonds all the time, but if you actually look closer, these instruments are massively diverse and, frankly, surprisingly nuanced.
That's absolutely right. Our sources really confirm this is an area where a little bit of knowledge goes a very long way, especially for you, the discerning investor. So our mission today is simple. We are moving far beyond the simple description of a bond as just an IOU. We're going to conduct a deep dive into the very fabric of debt securities. We'll explore the mechanics of pricing, the critical features, the extensive taxonomy of bonds, and perhaps most importantly, we will dissect the risks that make fixed income anything but truly fixed or boring. We want you to walk away understanding the subtle but profound difference between a zero-coupon bond and a Methuselah.
I really appreciate that focus on nuance. We have a robust stack of material defining this instrument, detailing its history, laying out its diverse categories, and warning us about the inherent risks. It's time to find those aha moments hidden in the fine print of a bond indenture. Okay, let's unpack that core definition. We often say a bond is an IOU, but what does that really mean, legally and financially?
Fundamentally, a bond is an instrument of indebtedness. It's a security under which the issuer, the debtor, whether that's a government or a large corporation, owes the holder a specified debt. The holder is the creditor. You are the lender. It's really just a formalized loan, but it's often broken up into small, tradable units.
And that formality, it carries a real legal weight, doesn't it?
A significant obligation, yes. The issuer is legally bound to provide a cash flow based on the terms laid out in the bonds contract or its indenture. And this cash flow consists of 2 primary commitments. First, repaying the principal, that's the original borrowed amount, at a pre-specified maturity date, and second, paying interest, which we famously call the coupon, over a defined period of time.
It's so interesting how long this basic concept has been around. The source material notes that the use of bond as a financial instrument that, binds one party to pay another dates back to at least the 1590s. It ties right back to the etymology of the word bind. It is, like you said, an ancient concept just modernized.
And that heritage is important because unlike equity, which can be highly adaptable, the terms of debt are historically very, very rigid. Once that bond is issued, the issuer is bound to that cash flow schedule, no matter what.
So before we get into the structure, we have to address this essential distinction, the one that separates the bond world from the stock world. It's the great divide in investing, the difference between ownership and lending.
This is the critical starting point for any learner. You have to get this. When you buy a stock, you are buying an equity stake. You are a partial owner of the company. You participate in its profits and you share in its losses.
You're along for the ride.
Exactly. But when you buy a bond, you gain a creditor stake. You are simply a lender. Your return is fixed by the contract. You don't get to share in any excess profits if the company has a blockbuster year.
But you're also shielded from the immediate losses, right?
Right. You don't absorb losses until the issuer actually defaults on its payments.
And this difference in status, it matters immensely when that company or that entity runs into financial trouble. Where do I, as a bondholder, stand in the hierarchy, in the pecking order?
You stand much, much higher than a shareholder. Bondholders, as creditors, have priority over stockholders in a bankruptcy or liquidation scenario. They get repaid in advance of the owners. In many, many high-profile bankruptcies, the equity holders are just wiped out entirely. Their stock goes to zero.
And the bondholders?
The bondholders still have a chance to claw back some percentage of their investment. I mean, sometimes it's significantly reduced, but it's still more than zero.
Okay, so you're ahead of the shareholders, but are you at the very top of the list?
Not quite. It's crucial to remember that while you are ahead of the stockholders, you still rank behind secured creditors. A secured creditor is often a bank whose loan is backed by specific collateral like real estate or machinery. They get paid first from the sale of that specific collateral.
So they have a direct claim on an asset.
Precisely. Bondholders are typically unsecured creditors, meaning they rely on the general assets of the company, but they are still definitively, legally ahead of the shareholders.
So if the company goes under, the bondholder stands a chance of recovery. The stockholder usually does not. Another core difference is just the lifespan of the instrument itself.
Exactly. Stocks generally remain outstanding indefinitely. They last as long as the company exists. Bonds, on the other hand, have a defined term, or maturity, after which the debt is redeemed and the obligation is liquidated, the contract is over.
Although you did mention that rare, almost mythological exception to the rule.
Yes, the irredeemable bonds, or perpetuities, they have no maturity date, which means the issuer only has to pay the coupon forever and never repays the principal. They're historically significant, but for all practical purposes, bonds are temporary instruments.
And one small but important clarification from our sources here. We are focusing on long-term debt. So what are we excluding based on that term length?
We are excluding instruments that are typically under 1 year in length. Things like short-term commercial paper or bank certificates of deposit, CDs, those fall under the category of money market instruments.
So when we talk about bonds, we're really talking about securities used for long-term capital financing.
Correct.
And who is participating in this massive long-term lending market? Who's issuing these things?
Oh, the list of issuers is comprehensive. You have governments, all the way down to local authorities. You have credit institutions, corporations of all sizes, and specialized supranational institutions like the World Bank or the European Investment Bank. It's a truly global ecosystem.
And for it to be an ecosystem, these things have to be tradable.
Crucially, yes. Almost all modern bonds are negotiable. This means ownership can be transferred easily in what's called the secondary market. If they weren't easily sellable, they just wouldn't be attractive to investors. This liquidity is facilitated by transfer agents. Historically, this required a really cumbersome process, like a medallion signature guarantee, to verify ownership when you were transferring the physical security. Today, thankfully, most of this is electronic.
And with that sheer volume of debt being traded, you must need a clear way to identify them. If I'm looking at a complex global portfolio, how do I know exactly which security I'm looking at?
That's where standardization comes in. Bonds are uniquely identified by the International Securities Identification Number, or IS.
ISIN.
Right. It's a 12-digit alphanumeric code that allows the security to be tracked, listed, and traded globally. And this is essential given that the bond market is often decentralized and over-the-counter, or OTC, which is very different from stocks that trade on a few central exchanges.
Okay, now that we have the foundational contract established, let's break the bond down into its core components. We have to start with the amount borrowed, the principal. What should you, the learner, know about this central figure?
The principal is the heart of the bond. It's also known as the nominal amount, par value, or the face amount. This is the figure the issuer uses to calculate interest payments, and it is the amount the issuer is obliged to repay at the end of the term.
And there's a standard amount, right?
For simplicity, yes. Most corporate bonds and treasuries are issued with a face value of $1,000. It just makes the math easier for everyone involved.
You mentioned in part one that for a plain vanilla bond, par is what you get back. But what about those exceptions that make things complicated?
The complexity really arises in what are called structured bonds. In these cases, the redemption amount might be different from the face amount. For example, a bond might have its principal repayment linked to the performance of a certain stock index, or maybe a basket of commodities.
So your principal isn't guaranteed?
Not necessarily. If the index rises, the bondholder gets more than the nominal amount. But if it falls, they might get less. This adds an element of, well, non-fixed return to the fixed income world. But these are very specialized instruments.
Moving on, we tackled the dimension of time, maturity. How flexible is the bond market when it comes to the term length?
The term, or the tenor, can be incredibly flexible. It can range from slightly over 1 year to many, many decades. The maturity date is fixed when the bond is issued. After this date, assuming all payments were made, the issuer's contractual obligations are complete.
And for most investors, the easiest way to categorize maturity is to look at the standards set by the big liquid markets, like the U.S. Treasury.
Exactly. They have very precise terminology based on the length of the loan, and it's language you hear all the time. So you have bills, or T-bills. These are short-term debt maturing in under 1 year. Then you have notes, or T-notes. That's medium-term debt maturing between 1 and 10 years. And finally, bonds, or T-bonds. That's long-term debt maturing between 10 and 30 years.
And understanding that distinction, Bill, note, bond is essential when you're talking about U.S. government debt. Because while they're all just debt, They behave very differently in a portfolio, especially when it comes to interest rate risk.
Absolutely. A 30-year bond is far, far more sensitive to interest rate fluctuations than a one-year note is. We'll definitely get more into that later.
Okay, that sets up the timing. Now let's discuss the predictable income stream, the coupon. What's the standard mechanism for payment?
The coupon is the interest rate, and it's stated as a percentage of the nominal value that the issuer pays to the holder. The payments are overwhelmingly semi-annual or annual.
The history of the name is one of my favorite financial anecdotes. It's so literal.
It truly illustrates how physical this market once was. When bonds were paper certificates, they literally had perforated slips attached to them, the coupons.
So you'd actually clip them.
You would physically detach one of these slips every 6 months, take it down to your bank, and hand it in to receive your interest payment, hence the coupon rate. That process, of course, is entirely electronic now, but the name just stuck.
And we have two major structures for how that coupon payment works: fixed and floating. Give us the rundown on why an investor would choose one over the other.
The fixed-rate bond is the default assumption. It's what most people think of. The coupon rate is constant for the entire life of the bond. If you buy a 5% fixed-rate bond with a $1,000 face value, you know exactly what $50 you're going to receive every year for the next 10 years.
So it offers predictability.
Total predictability of income. Now, floating rate notes, or FRNs, they do the opposite. They offer dynamic protection. The coupon is not static, it varies. It varies because it is linked to a money market reference rate, something like SOFR. That's the secured overnight financing rate, or Euribor in Europe. The coupon rate is usually that reference rate plus a defined spread or margin.
So if the reference rate goes up, my coupon payment goes up, and if the reference rate falls, my payment falls.
Exactly. The rate is recalculated periodically. It could be monthly, quarterly, or semi-annually. FRNs are excellent instruments if an investor is worried about rising interest rates.
Right, because in a rising rate environment, the market value of a fixed-rate bond falls, but an FRN's value.
It remains relatively stable because its interest payment adjusts upwards to meet the new market rates. The trade-off, of course, is that the investor gives up that predictability of income.
Okay, we've covered the fixed amounts, principal, and coupon. But the real rate of return, the thing everyone cares about, is defined by the yield. And this is where clarity is just essential. We have to distinguish the simple current yield from the much more complex yield to maturity.
You absolutely must remember this distinction. The coupon rate is the interest rate printed on the bond's face. The yield is the actual return you, the investor, receive based on the price you paid for the bond in the market today. They are not the same thing unless you buy the bond at exactly its par value.
So let's start with the simpler one, current yield.
The current yield, or sometimes called the running yield, is a simple calculation. You just take the annual interest payment and divide it by the bond's current market price. If a bond pays $50 annually but is trading at $900 today, your current yield is 5.55%. It's a simple cash-on-cash measure for right now.
Simple, but it doesn't tell the whole story.
Not at all. Which brings us to the gold standard for bond assessment, yield to maturity, or YTM. Can you define that for us and tell us why it's so critical? YTM, also known as the redemption yield, is the estimated total rate of return you can anticipate if you buy the bond at today's price, hold it all the way to maturity, and receive all scheduled coupon payments and the final principal. It's the single interest rate that equalizes the present value of all the bond's future cash flows with its current market price. It is, for all intents and purposes, the true measure of your anticipated compounded return.
That sounds definitive, which is why people rely on it. But here is the massive caveat we must spend time on. The one that undermines the certainty many casual investors assume YTM offers.
This is the critical nuance. I mean, it's what financial professionals understand well, but it often confuses the general public. The YTM you see calculated on your screen when you buy a bond, it is only a potential rate of return. It is absolutely not a guarantee.
Okay, so why isn't it a guarantee?
You only realize that exact YTM if two very stringent and frankly hypothetical conditions are met throughout the entire life of the bond. First, the investor has to ensure that all those semi-annual coupon payments, which are cash flows, are immediately reinvested into new assets rather than being spent.
Okay, so you can't use the income, you have to put it back to work.
Exactly. And second, and this is the killer, every single one of those coupon payments must be reinvested at the exact same interest rate as the initial YTM you calculated when you first bought the bond.
So, if I buy a 15-year bond today with a calculated YTM of 7%, I only truly lock in that 7%. If, for the next 15 years, every single coupon I receive can be immediately put back into the market and earn a consistent, compounding 7% return.
Precisely, which is almost impossible. If, over those 15 years, market interest rates fall, you are now forced to reinvest your coupons at a lower prevailing rate, say 5% or 4%. This shortfall is known as reinvestment risk.
And it means my actual total return over the bond's life will be lower than that initial 7% YTM I was quoted.
It will be lower. This is a huge point of confusion. The YTM assumes the future market perfectly mirrors the present investment rate, which, as we know, is almost never true in the real world.
So YTM is really a theoretical calculation. It's a benchmark, not a promise.
Exactly. For an institutional investor, especially one focusing on total return, they have to factor in the uncertainty of that future reinvestment rate. For an individual, maybe a retiree, who is using the coupon payments for immediate income, what we call asset liability matching, the reinvestment risk might be irrelevant.
Because they're spending the cash, not reinvesting it.
Right. But for portfolio growth, YTM should always be viewed as an anticipated rate, one that's highly sensitive to future interest rate movements.
We know the anatomy. Now, how does a bond actually get created and sold? Let's start with the corporate and institutional side, the primary market, which relies heavily on something called underwriting.
Right. So when a corporation needs to raise a large amount of capital via debt, they turn to securities firms and investment banks. These firms form a syndicate, which is led by a small group known as bookrunners. The syndicate then buys the entire issue of the bonds from the issuer. They're essentially acting as a middleman. And then they turn around and resell those bonds to investors like pension funds and mutual funds.
Why do they do that?
Yeah.
Why not just have the company sell the bonds directly to the public?
Because the banks take on the underwriting risk. The issuer, the corporation, gets their guaranteed lump sum of cash immediately. They're happy. The banks then assume the risk that they might not be able to sell all the bonds to the public at the price they're hoping for.
And they get paid for taking that risk.
Of course. They charge a fee for this service.
And the role of the book runner, you said, is pivotal in this process.
They are the orchestrators. They arrange the whole issue. They advise the issuer on all the critical factors: timing, interest rate, the optimal price to maximize the proceeds while ensuring the bonds actually sell. They're listed prominently in any announcement of the issue, traditionally called the tombstone ads, which reflects their lead role in bringing the debt to market.
Are there alternatives for smaller issuers who maybe can't afford that big process?
Yes. For smaller or maybe highly specialized issues, they might opt for a private placement. This avoids the underwriting cost entirely because the bonds are sold directly to a select, sophisticated group of investors, usually large institutions.
What's the trade-off?
The trade-off is that these bonds are often less liquid. They're not easily tradable in the wider secondary market because they weren't registered for public sale. And historically, we also had something called the tap issue, which was used primarily by governments. The government would offer bonds over a period of time at a preset fixed price, but the volume they issued depended on market demand on any given day.
So they could just tap the market when conditions were right?
Yep. Exactly. It's less common today for major issues.
Speaking of governments, their bonds, treasuries, are typically issued through a different mechanism entirely. The auction. How does that differ from underwriting?
The government auction process is more market-driven right at the point of sale. The government, unlike a corporation in an underwriting deal, it fixes the terms, the maturity, and the coupon rate in advance. Then banks and approved market makers, and sometimes the public, they bid for the bonds. The price, and therefore the yield that the investor receives, is determined by the collective market bids. This method ensures that the debt is priced fairly based on current supply and demand.
Okay, so once the bond is issued, it moves into the secondary market. If I want to buy an existing bond, what dictates its market price?
The market price is the outcome of a financial calculation. It is the present value of all the expected future cash flows, that's the stream of coupons, and the final principal payment, all discounted back to the present using the current required yield to maturity. And this brings us back to the most critical concept in bond valuation, the inverse relationship. When market interest rates rise, bond prices must fall. And when market interest rates fall, bond prices must rise.
Let's just dedicate a moment to making sure we all completely grasp why this relationship is non-negotiable. It's so fundamental.
It is. Consider this. A corporation issues a 10-year bond 2 years ago with a 4% coupon. You paid $1,000 for it at the time. Today, the central bank raises interest rates, and new comparable 8-year bonds are being issued with a 6% coupon.
Okay.
Now, if you try to sell your old 4% bond for $1,000, why would anyone buy it? They can just go buy a brand new 6% bond for the same price and get a higher income stream.
They wouldn't. It
They
makes
aren't.
no sense.
They won't. Therefore, the market price of your old 4% bond must drop below $1,000. It has to trade at a discount. And it will keep dropping until the overall return it offers, which includes the gain you get when it pulls to par at maturity, equals the 6% rate available on the new bonds. The price adjusts downward until the yield is competitive. This is the mechanism by which the bond market maintains equilibrium.
That makes the mechanics crystal clear. So in the market, how are prices quoted?
Prices are expressed as a percentage of the nominal value, or par. Par is always 100. So if the price is greater than 100, say 105, the bond is trading at a premium. This usually means market rates have fallen since it was issued. If the price is less than 100, maybe 95, it is trading at a discount. This means market rates have risen, or perhaps the perceived risk of default has gone up.
And when we're discussing price, we have to clarify the difference between the clean price and the dirty price.
Yeah.
This catches a lot of people out.
It does. So when a coupon payment is due, you receive the full interest amount for the previous 6 months. If you buy a bond exactly halfway through that 6-month period, the seller is entitled to half of that next coupon payment because they held the bond for half the period.
Totally fair.
Right. So the dirty price includes this accrued interest, which is common in Europe. The clean price, which is the standard quoted price in the U.S. market, excludes the accrued interest. But when you actually execute a trade, the cash settlement you pay is the clean price plus the accrued interest. This just ensures the seller is compensated for the days they held the debt since the last payment.
A final dynamic related to price is the pull-to-par phenomenon.
This is a really predictable behavioral feature of bonds. As a bond gets closer and closer to its maturity date, its market price, whether it was trading at a premium of 120 or a discount of 80, must gradually converge toward the par value of 100.
And why is that?
Because on that maturity date, the issuer is contractually obligated to repay exactly 100, no more, no less. So the market price has to meet that fixed endpoint. This convergence reduces the price volatility as maturity gets closer, assuming, of course, that the issuer is still financially healthy and expected to pay.
That leads us perfectly into the risk side of the equation. Credit quality. What is the fundamental measurement here?
Credit quality measures the probability that the bondholder will receive all promised payments, both coupon and principal, on time and in full. This is the domain of the big credit rating agencies like Standard & Poor's or Moody's. They assign ratings from AAA, which is the highest, all the way down to D, for default.
And this rating is what determines whether a bond is considered investment grade or high yield.
Correct. Bonds rated below investment grade are universally referred to as high-yield bonds, or the more famous term, junk bonds. Investors demand a significantly higher yield for these because the chance of default is materially higher. They need to be compensated for taking on that additional credit risk.
You touched on this earlier, but let's elaborate. Are there truly any risk-free bonds? We typically treat U.S. Treasury bonds as the benchmark for safety.
The financial world operates under the convention that U.S. Treasury bonds are risk-free. They're backed by the full faith and credit of the U.S. government, which can, in theory, always print money to pay its debts. However, our sources do note that in reality, no bond is entirely risk-free. Even the most stable governments carry some minute residual risk.
And we can see evidence of this in the market.
Oh, absolutely. We see it when we look internationally. Different sovereign governments, even those within the Eurozone where the currency risk is removed, issue bonds that trade at different yields. This reflects the market's perceived differences in their ability or willingness to pay. A bond issued by Germany might be rated AAA, but another large developed nation might only achieve AA plus nation. This tells you the market assesses slightly different risk levels, even among the safest debtors.
So the bond market is acting as this impartial mechanism for continuously pricing sovereign risk.
All day, every day.
The universe of fixed income is vast, and the terms we use change depending on who is issuing the debt. Let's start with the taxonomy, categorized by the nature of the issuer and the security they offer.
We begin at the top with government bonds, or treasury bonds, issued by sovereign national governments. And while the most stable nations are the benchmarks for safety, we must never forget the historical reality. Nations do default, or they restructure their debt.
It happens more often than people think.
Absolutely. Argentina, Greece, Russia, and others serve as stark reminders that sovereign risk is always present, even if it feels remote from major global powers.
Just below that sovereign level, we find supranational bonds, or supras.
These are debt instruments issued by organizations that transcend national boundaries, like the World Bank or the International Monetary Fund. Because they are often backed by many highly rated member governments, they tend to carry extremely good credit ratings, often at the highest level, AAA. This makes them favorites for conservative institutional investors.
Next up are municipal bonds, or munis, which are issued by local authorities, cities, or federal states. In the U.S., their primary draw is the favorable tax treatment.
Munis are unique because their interest payments are frequently exempt from federal income tax, and sometimes they're also exempt from state and local taxes if you, the bondholder, reside in the state that issued it.
So it's a double or even triple tax-free income stream.
Potentially, yes. And this tax advantage means the issuer can offer a lower nominal coupon rate than a corporate bond, yet the after-tax return for the investor can still be competitive or even superior. Within munis, we have a crucial subset, revenue bonds. These are interesting because they isolate the risk.
How exactly does that isolation work?
Revenue bonds are typically non-recourse debt. This means their repayment is guaranteed only by the revenues generated by a specific, dedicated project they funded. For example, a new bridge, a public hospital, or a sports stadium. So if the toll road fails to generate enough revenue to cover the debt payments, the bondholders usually cannot seek payment from the city's general tax revenue fund. Their claim is limited to that project's cash flow.
That makes the credit analysis very localized. You're not evaluating the financial health of a whole city, you're evaluating the business plan for a single bridge.
Precisely. And we should also mention the Build America bonds, or BABs, which were authorized back in 2009. These were an interesting hybrid. Unlike traditional munis, their interest was subject to federal taxation.
Which seems like a disadvantage.
It was, but they were exempt in the state of issuance. And crucially, they often offered higher yields than standard munis because of government subsidies. This was designed to attract a broader base of taxable investors to municipal projects.
We can shift gears slightly to corporate bonds, issued by corporations, and the more specialized debt instruments, like climate bonds or green bonds.
These specialized bonds are corporate or government debt, where the proceeds are specifically earmarked for environmentally beneficial or climate-related projects. For example, when the UK government issued its green bonds in 2021, the expectation was that the money raised would only be used to fund things like renewable energy or sustainable infrastructure.
So they satisfy investors looking for both a financial return and a specific environmental impact.
Exactly. It's a growing market.
And historically, we also see bonds with a very distinct purpose: war bonds.
These are government bonds issued specifically to finance military operations or wartime expenditure. They are often sold with powerful patriotic appeals, and they typically offered a lower rate of return than the market might otherwise demand. They often served more as a patriotic contribution than a pure financial investment.
Finally, in this issuer category, we have the highly complex asset-backed securities, ABS, which gained a lot of notoriety in the 2008 crisis.
Right. ABS are bonds whose payments are derived from the cash flows of underlying pooled assets rather than the general creditworthiness of the bank or entity that's issuing them. Think of it this way. Instead of a bank keeping 1,000 mortgages on its books, it pools those mortgages together, creates a legal trust, and then sells bonds, mortgage-backed securities, or MBSs, that are backed by the homeowner's monthly payments.
So the bondholder isn't relying on the bank, they're relying on the homeowners.
Exactly. Other examples include CDOs, which are collateralized debt obligations, or CMOs. The key is that the bondholder is relying solely on the consistent performance of the underlying collateral, whether that's mortgages, car loans, or student debt, to generate the cash flows necessary for repayment.
Okay, let's move to category B, term to maturity. Beyond the standard Treasury definitions, we have some remarkable outliers, like the bonds with no end date.
Yes, the perpetual bonds, or PERPs. As we mentioned, they obligate the issuer to pay interest indefinitely without ever returning the principal. The famous example is the UK consols, some of which dated back to the 1888 conversion or even earlier before they were finally fully repaid in modern times. They're essentially an annuity that lasts forever.
But today, the longest debt instrument that is growing in prominence is the Methuselah bond.
A fantastic term for a 50-year, 70-year, or even 100-year bond. Their increasing issuance, particularly in the UK and France, is driven by the specific needs of large institutional investors, pension funds and insurance companies.
Why them specifically?
Because these entities have extremely long-term liabilities, they have to pay pensions decades into the future, and Methuselah bonds provide an asset with a matching long duration, which helps them reduce their exposure to that reinvestment risk we talked about earlier. And then we have the truly bizarre, ultra-long instruments, like the West Shore Railroad bond that matures in the year 2361. Financially, the present value of receiving your principal back in 350 years is negligible. It's almost zero. So it behaves like a perpetuity for all intents and purposes.
A more manageable but still distinct maturity structure is the serial bond.
Instead of a single maturity date where the entire principal is due, the principal is paid back in scheduled installments over time. For example, a $100 million bond issue with a 10-year term might be structured so that $10 million in principal matures and is retired every single year for 10 years. It reduces the total outstanding debt load incrementally.
Okay, let's transition to Category C. By coupon payment conditions, we know fixed and floating rates, but the zero coupon bond is a fundamental instrument with a really unique tax complication.
Zero coupon bonds, or zeros, are fundamentally different because they pay no regular coupon interest. They are issued at a deep discount to their par value. The entire return, which represents the interest, is realized when the bondholder receives the full principal amount at maturity.
So if I buy a 10-year $1,000 zero coupon bond for, say, $600 today, the $400 I will eventually receive is my interest. But the tax implication, that's tricky.
It is extremely tricky, particularly in the U.S. In many jurisdictions, the IRS views the accretion of that interest, that $400 difference, as income that's earned annually, even though you haven't received a single dollar of cash flow yet. This is called imputed interest.
So you've received no cash, but you get a tax bill every year on the portion of the discount that is accrued since the last period.
Exactly. This makes zeros highly inefficient for taxable accounts. But it also makes them incredibly valuable for tax-deferred accounts, like retirement funds, where the interest can compound without that immediate taxation.
That makes the tax treatment a crucial deciding factor for using zeros. And you also mentioned that zeros can be engineered. Explain the fascinating process of stripping.
Stripping is the act of surgically separating the components of a regular fixed-rate bond. A financial institution can take a 20-year bond that has 40 semi-annual coupons, and they can separate those 40 coupon payments and the final principal payment into 41 individual zero-coupon instruments.
Creating a whole new set of securities from one original bond.
Right. This creates what are called interest-only, IO strips, and a principal-only, PO strip. Stripping allows institutions to create bonds with extremely precise maturity dates and highly specific duration characteristics, which is essential for duration matching in complex portfolios.
We also have bonds designed specifically to counteract the greatest enemy of fixed income, inflation.
These are inflation-indexed bonds, known as linkers in the UK or TIPIAS Treasury inflation-protected securities in the US. Their design is really genius. The bond's principal amount and the interest payments are indexed to an inflation measure, like the Consumer Price Index, CPI.
So how does that work in practice?
If inflation spikes, the face value of the bond is adjusted upwards. And because the coupon rate is applied to that adjusted face value, the dollar amount of the coupon payment also increases. You get guaranteed protection against inflation eroding your purchasing power.
What's the catch?
The trade-off is that they offer a real interest rate. That's the return above inflation, which is typically lower than the nominal rate you'd get on a comparable fixed bond.
Let's move to Category D, documentation and jurisdiction. This involves some remarkable historical context, starting with the now largely prohibited bearer bond.
Bearer bonds were the ultimate financial relic. They were issued without the holder's name recorded anywhere. The physical paper certificate was the sole evidence of ownership. Whoever held it, the bearer, was the owner, and they collected the physical coupons.
Despite the obvious risk of loss or theft or fire, why were they so highly prized for so long?
They provided perfect anonymity. For decades, they were the instrument of choice for tax evasion, money laundering, and capital flight because the owner simply could not be traced by any tax authority.
And this tension between privacy and regulation ultimately led to their demise.
It did. The U.S. government prohibited the issuance of tax-exempt state and local bearer bonds entirely back in 1983.
So the modern solution, ensuring traceability, is the registered bond.
Registered bonds require the owner's name and address to be recorded by the issuer or an official transfer agent. All payments are sent directly to that registered owner. If the paper certificate is lost, the owner is safe because the records still exist. They're much safer, but historically they were less liquid than bearer bonds because transferring ownership required canceling the old bond and issuing a new one.
But today, even registered bonds are largely outdated due to the book entry bond.
Book entry bonds are entirely electronic. There is no physical paper certificate at all. Ownership exists only as an entry on the ledger of the issuer or the clearing system. This is the standard today. It offers maximal security, liquidity, and minimal administrative cost.
Finally, we should briefly acknowledge foreign currency bonds like the samurai bond.
These are bonds issued by an entity outside of its home country but denominated in the foreign currency. So a company or government issuing a samurai bond is a non-Japanese entity issuing bonds denominated in Japanese yen, governed by Japanese law.
Why do that?
They do this to tap into foreign capital markets or perhaps to hedge exchange rate risk. But for a government, issuing debt in a foreign currency is a very serious commitment. They sacrifice the option to inflate their domestic currency to effectively reduce the real value of the debt owed. They lock themselves into the foreign currency's value, which can be catastrophic if that foreign currency strengthens significantly against their own.
The bond world isn't static. It often incorporates mechanisms for flexibility, known as embedded options. These grant either the issuer or the holder the right to alter the terms, which significantly changes the risk profile. Let's start with callability, which is an option that favors the issuer.
Callability gives the issuer the right, but not the obligation, to repay the debt before the stated maturity date. It's fundamentally a refinancing option for the issuer, and it's analogous to a homeowner refinancing a mortgage.
How so?
If interest rates fall significantly after the bond is issued, the issuer can call the bond back, pay off the principal, and then issue new debt at a lower prevailing coupon rate, saving themselves a lot of money in interest payments.
And the issuer is usually willing to pay a little extra to gain that flexibility, right?
Often, yes. While most callable bonds allow redemption at par, especially high-yield callable bonds may require the issuer to pay what's called a call premium to the investor. This is to compensate them for losing that high-rate income stream earlier than expected.
And we have three basic structures for when a bond can be called.
The simplest is the European callable, which has only one defined call date. The American callable is the most flexible for the issuer. It can be called at any time, usually after an initial protection period, all the way until maturity. And the Bermudan callable offers flexibility on multiple specified dates, which usually coincide with coupon payment dates.
Okay, on the flip side, we have putability, which gives the power back to the holder.
Putability gives the holder the right to force the issuer to repay the bond before maturity. These are extremely popular with investors because they offer interest rate protection and liquidity.
How does it protect them?
If market rates rise sharply, which would reduce the value of their bond, the investor can put the bond back to the issuer at par, recover their capital, and immediately reinvest it at the new, higher market rate.
And there's a specialized version of this that's often included in municipal bonds.
Yeah.
The death put.
Right. The death put, or survivor's option, allows the estate of a deceased bondholder to sell the bond back to the issuer at face value. This just provides the estate with immediate liquidity without having to sell the bond on the open market, where it might be trading at a discount.
We must also discuss the popular hybrid, convertible bonds.
Convertibles are fascinating. They combine the safety of debt with the potential of equity. They give the holder the option to exchange the bond for a predetermined number of the issuer's common stock shares.
So you get the best of both worlds.
You can. If the company's stock performs well, the bondholder can convert their debt into equity and participate in the upside. If the stock performs poorly, they simply keep the bond and continue receiving their fixed coupon payments.
And finally, the sinking fund provision.
This is a covenant that requires the issuer to retire a certain specified portion of the bond issue periodically before maturity. The issuer can meet this obligation either by buying bonds on the open market or by randomly calling selected bonds in the issue. It provides additional security to the bondholders because it systematically reduces the outstanding debt exposure over time.
Now, for what might be the most crucial part of this deep dive, the investment reality. Bonds are often mislabeled as simple or even risk-free. What are the specific serious risks that bond investors face?
That perceived safety is so misleading. Bonds are profoundly exposed to risks that stocks don't face, and the most notable one is interest rate risk. We covered the inverse relationship, but let's look at the actual consequence. If you hold a long-term fixed-rate bond and interest rates rise, the capital value of that bond falls, sometimes sharply. If you're forced to sell that bond before maturity for some reason, you will realize a capital loss.
How do professionals quantify this exposure to interest rate risk? It sounds like we need a measure that goes beyond just the simple maturity date.
We do, and we use the term duration. Duration is the single most important measure in fixed income. Conceptually, it measures a bond's sensitivity to changes in interest rates.
Can you give an example?
Yeah. A 10-year bond might have a duration of, say, 7. This means that if market interest rates rise by 1%, the bond's price is expected to fall by roughly 7%. The key rule is, the longer the maturity and the lower the coupon rate, the higher the duration, and therefore, the higher the interest rate risk.
Next, we have credit or default risk, the chance that the issuer simply fails to pay.
And this is a risk that's distinct from interest rates. An unexpected downgrade by a rating agency like S&P or Moody's, driven by deteriorating corporate health or unexpected political events in a sovereign nation, will cause the market price of the bond to plummet immediately.
Why immediately?
Because the probability of you receiving your future cash flows has suddenly decreased. And the market, in response, requires a much higher risk premium, a higher yield to hold that debt. So the price has to drop.
And the ultimate realization of that risk is bankruptcy risk. Even with priority over stockholders, bondholders don't always walk away whole.
Not at all. There is no guarantee of full repayment. The WorldCom bankruptcy in the early 2000s is a classic cautionary tale. Despite bondholders ranking high up the liquidation chain, after the lengthy legal process and the claims of secured creditors were settled, the bondholders recovered only 35.7 cents on the dollar in 2004. The recovery amount is highly dependent on the quality and liquidity of the remaining assets.
We also discussed the risk associated with flexibility call and reinvestment risk.
This is the risk that arises when an issuer calls a bond early. And as we established, that happens almost exclusively when interest rates have fallen. So the investor receives their principal back, but is forced to take that money and reinvest it in the current environment, which now offers much lower prevailing interest rates. The investor loses their locked-in high coupon and is forced to accept a lower yield moving forward.
We should acknowledge a few more crucial risks that often get glossed over. First, liquidity risk.
Liquidity risk is the risk that you cannot sell your bond quickly without significantly depressing its price. While major government bonds are highly liquid, many niche corporate bonds or complex municipal bonds can be very thinly traded. If you need to sell quickly, you might be forced to accept a deep discount just to find a buyer.
And what about event risk?
Event risk is the chance that a single, sudden corporate event, like a massive leveraged buyout, an LBO, or a significant operational disaster, causes the credit quality of the issuer to instantly deteriorate. These events are unanticipated and often lead to massive, immediate price drops.
And finally, let's define inflation risk in the context of fixed bonds.
Inflation risk is the simple but corrosive risk that if inflation rises unexpectedly, the fixed payments you receive from your bond, your coupon, and your final principal will buy less in the future than they do today. Your nominal return might be positive, but your real inflation-adjusted return could easily be negative. And this is precisely why inflation index bonds exist, to specifically eliminate this risk.
It's clear the bond market is a maze of interwoven complexities. And unlike the stock markets we often see on TV, the structure of the bond market itself is different.
Indeed. Most developed bond markets, the corporate debt market, the government debt market, they do not trade on centralized exchanges like the NYSE. They are decentralized, dealer-based, over-the-counter OTC markets. Liquidity is provided by large banks and securities firms that act as dealers. They commit significant risk capital, buying and selling bonds and holding them in inventory to ensure that when an institutional client wants to buy or sell, there is always a counterparty. This facilitates the massive daily volume of trading.
And just like stocks, investors rely on large indices to track performance.
Yes. Bond indices, such as the Bloomberg Barclays U.S. Aggregate Index or the Citigroup Big Bigger, are critical tools. They're used by institutional investors and mutual fund managers to measure the performance of broad segments of the bond market, allowing them to benchmark their portfolios and assess the overall health of the market. Hashtag tag to outro.
We have executed a thorough and comprehensive tour of the fixed income landscape. I mean, we've moved from a simple IOU to understanding callable zero-coupon bonds. The depth of the mechanics here is truly profound, and we've uncovered some essential knowledge nuggets for you.
Absolutely. The foundational takeaway has to be the legal reality that you are a creditor with priority, not an owner. That simple fact fundamentally structures your entire risk and return profile. That is non-negotiable.
And the complexity hidden within the core features is immense, specifically the yield to maturity. Understanding that realizing the calculated YTM requires the almost impossible condition of perfectly reinvesting all future coupons at that exact same rate, that's a critical piece of knowledge often overlooked by individual investors.
We also saw how history shaped the market mechanics, didn't we? From the physical clipping of coupons to the rise and fall of the bearer bond, an instrument of perfect anonymity that provided a vehicle for tax evasion until it was strictly prohibited. Analyzing a bond's specific features, its coupon structure, its duration, its embedded options, is the only way to correctly price the risk you are taking on.
We established that governments sometimes default, and even risk-free bonds carry some residual risk. We also touched upon the historical longevity of perpetual and ultra-long-term debt instruments, like the UK consols and the modern Methuselah bonds, which mature many decades after they're issued.
And this raises an important question that connects finance to the very nature of governance and intergenerational responsibility. If a government issues a 100-year Methuselah bond today, how does that ultra-long-term debt fundamentally change the issuer's incentive structure compared to issuing short-term 5-year debt? And how might that decision burden or benefit generations far in the future who weren't even born when the debt was incurred?
A fascinating long-term economic question to take with you and explore further. Thank you for diving deep with us. We'll see you next time on The Deep Dive.